earnings season is now right around the corner. But you know what? We're in that period where Wall Street analysts, in their infinite wisdom, pen their preview notes telling us what's going to happen. Normally, these preview notes really aren't that compelling. Occasionally, though, something interesting really does happen. Like this morning, when we got a genuine analyst gunfight over the stock of Netflix. Barclays downgraded the stock from equal weight to underweight. That's actually a hold to sell, while keeping their very low price target at $5.50. At the same time, Piper Sandler upgraded Netflix from neutral to overweight, hold to buy, and took their price target from $6.50 to $800. Keep in mind, this is currently a $701 stock. Now, I love these analyst face-offs because they help us pit the best arguments of the bulls against the best arguments of the bears. You know, it makes it easier to know where you stand given all the available information. It also steals you for something goes wrong. You've already thought about it ahead of time. Let's start with the hit piece presented by the team of analysts at Barclays. These guys argue, and I'm going to quote, Netflix's premium valuation is predicated on revenue growth being at least in the low double digits for some time, end quote. But they think it'd be hard for the streaming giant to hit those numbers. In fact, Barclays argues that even if Netflix hits its revenue targets, the stock's current valuation pretty much assumes the company can more than double its subscriber base, which is a pretty tall order. As they see it, Netflix is now a slowing growth story that trades like a steady growth story. In their view, while the company still has levers that can boost growth, these all come with serious trade-offs. In short, after years of outsized growth, Barclays actually believes that Netflix will find it harder and harder to keep delivering, which is a problem because the stock now trades at over 30 times next year's earnings estimates. Very hard to justify that premium valuation if they can't maintain at least a double-digit growth rate. Barclays also argues that as Netflix moves from a pure subscription-based system to something more of a hybrid subscription and advertising model, and the company invests in things like video games, live events, its margin expansion will slow. You know, it does sound pretty darn grim.
The House of Pain.
So what about the bull case for Netflix as presented by the team of Piper Sandler? Interestingly, this upgrade's also based on valuation, but in much different sense. Right at the top of the note, Piper explains, quote, our prior neutral stance was centered around valuation, but now we appreciate the company is expensive for a reason, end quote. Then they continue, quote, there are still levers to be pulled in the ads-free business, particularly around pricing, while the ads tier has been largely de-risked heading into next year, end quote. In a direct contrast, the Barclays downgrade, the Piper analyst says, quote, consensus margins could also prove to be conservative in 2025 and 2026 based on the incremental margins over the last few quarters, end quote. I like this. Overall, they see, quote, we see multiple scenarios to positive earnings revisions. Ooh, that's good news. Piper also likes the upcoming slate. Now, if you're curious, I certainly was for the upcoming slate. What do we got here? We got Emily in Paris season 4. Wife loves that one. Come out in September. The rescheduled Jake Paul versus Mike Tyson boxing match, now scheduled for November. Netflix's first ever NFL games, which will take place on Christmas. Season 2 of Squid Game comes out in December. And the arrival of the weekly WWE Raw program, which starts early next year. Now, personally, I can't wait for the NFL games on Christmas and Squid Game season 2. But that's it from this list, but don't take it from me. I'm not the usual guy. The Piper Sandler analysts argue that, quote, Netflix still has levers to drive non-ads business, end quote, conceding that the company is starting to lap tough subscriber comparisons because of the rollout of paid sharing roughly a year ago. They still think, though, that there's room for subscriber growth, but more important, Piper claims that Netflix has more pricing power, which means they can generate double-digit revenue growth without adding as many new people. In fact, they expect a price increase soon on the back of a very strong content ramp. Do you really think, by the way, that you would notice? I mean, please, it's Netflix. On top of that, the last time Netflix reported they had incredibly strong demand from advertisers, management decided to approach the space carefully. Piper thinks there's room for some upside surprise on the ad front going forward. The work I've done on this shows you that they can target ads better than almost anybody in the world. The bottom line for Piper Sandler, and the part of the call that I find least effective is this. Quote, streaming now represents 41% of television viewing in the U.S. for August 2024, up 270 basis points year over year, according to Nielsen Gauge, with Netflix being 20% of the streaming time spent and 8% of overall TV viewing, end quote. Frankly, as the pivot continues to streaming, we got to expect the company's going to maintain its leadership position, particularly as it adds more and more live content. That's what they say. To me, it's a yawner. But you know what? It's important to know that we're still pivoting. That's what these two firms are saying about Netflix. But where do I come down? All right, look, I'm going to stay bullish on this stock, just like the last time I covered an analyst duel on Netflix back in April. Since then, the stock's up more than 26%. That's right, since we got bullish, nearly doubling the performance of the S&P 500 over the same period. But let's talk about these arguments from Barclays and from Piper Sandler because they're important. First, I flat out disagree with Barclays' bearish assertion that Netflix can't hit the revenue estimates. After a period in 2022 and 2023 where Netflix did indeed miss sales numbers several times, they've now beaten top-line expectations for 4 straight quarters. More important, with their ad business now ramping, plus additional revenue from paid sharing plans, the company has more optionality than ever when it comes to how they're going to hit those revenue targets. And with Netflix no longer giving quarterly subscriber metrics starting next year, I think they can focus solely on hitting revenue expectations. That's the new key metric. How about the great margin debate? Well, Barclays is very negative here. Piper Sandler argues that even if Netflix can't keep expanding margins like it did this year, that doesn't mean they can't keep putting out more gradual growth. And we agree with that line of thinking. Finally, how about valuation? All right, Barclays argues that the stock's premium valuation requires the company to do certain things, and Piper Sandler asserts that Netflix is expensive for a reason. My view, I simply don't care. Maybe I'm wrong to be so blunt, but I honestly wouldn't get too hung up on the price earnings multiple for this company. You know, it's never pointed you in the right direction of the stock. What's more important is whether or not Netflix makes the numbers. If the company beats the earnings expectations, as it has in 10 of the last 12 quarters, then we don't need to worry about a stock's premium valuation, because the share price will look a lot cheaper in retrospect. If the company can't make the numbers, then the stock's got no reason to be expensive, and it's going to get hit. But the bottom line, until we hear of anyone canceling the Netflix subscriptions, maybe because of price, or about any real troubles with the advertising business, which we don't, or about the out-of-control costs of video games or live events, none of which has happened, then I think Netflix deserves the benefit of the doubt. And that's why I'm sticking with the bullish side of this trade. The bear thesis, I don't know, too hypothetical. Why don't we go to Susan in California? Susan.
Hey, man, it's great to hear your voice. I watch you every day. Thank you for
Thank you, Susan. Thank you very much. What's up?
But I have one problem. Years ago when Disney was hot and you were promoting it because it looked good, it started dropping. And unfortunately, I didn't sell it. So now I'm sitting for all these years with a loss. And it's sitting at 90. It's got a lot of people on buys. But I'm thinking of selling it and putting it into a stock that may do the same thing that I did with PayPal, by the way. Lost a lot on that. Put it into NVIDIA, figuring when NVIDIA ever hits 200, I'll be even. So what's your thoughts on Disney? Because
okay, well, let's talk about Disney. I spoke with Jeff Marks about it this very morning. You know, he works with me with the Travel Trust. And I said that if we weren't restricted on Disney, I would actually be a buyer of the stock here. It's come down quite a bit. It sells at 18 times earnings. It's down today because I think the storms. But you know what? Disney is doing much better than people realize. And it's about time people started giving a little more respect. I'm a buyer of it. The analysts are dumping all over it. They're dumping over it now. I say buy more Disney. Let's go to Julie in Colorado, please. Julie.
All right, Mr. Cramer, first-time caller, long-time listener and club member. Okay. Thank you for giving individual investors like me the confidence to believe that I can do this. I appreciate your education.
That's what I want. I want you to be able to do it. Won't always be here, but I know you will, and you're going to do it right. Let's go to work.
All right, my question today is about Dell. In an earlier Mad Money, like maybe early summer, Dell was named as a potential beneficiary of the AI trend and predicted to enjoy great growth fueled by expansion of sales from PCs needing upgrades to all this cool AI stuff. But since then, AI has dumped about 18%. Now, I'm trying to be a good student at Cramer University.
Right.
So my first thought was, okay, maybe the trend was just hype. I should do more homework. Second thought was I'd jump the gun, and Dell's going to be good long term, but it's going to take more time. So I'm noticing that there's been a lot of insider selling in the last month. I'm noticing that analysts are now supporting Dell and calling for it to be a long-term investment. So in its portfolio that's already a bit tech-heavy, is Dell a buy, a hold, or a sell?
Julie, never bet against Michael Dell. I look at that stock every day and think if we didn't have so many other AI-related semiconductor and hardware names, Dell would be top of my list. Michael Dell is working very close with Jensen Huang to be able to make it so that if you want to integrate NVIDIA into your operation, you go to Michael Dell. I think you should be going to Michael Dell and be a buyer of more stock in Dell. Joe in my home state of New Jersey. Joe.
Hello, Mr. Cramer, and thank you very much for taking my call.
Always great to hear from you, Joe. How can I help?
I currently own Visa, and with Visa set to acquire FeatureSpace, developer of AI, should I add to my position?
I don't think that, look, it sells at 27 times earnings. I'm waiting for Visa to come down at a discount. You don't have that. Right now, I have to tell you, MasterCard is actually doing a little better than Visa. But no need to add a position on that. That's not the right basis. Just look, it's a great long-term stock, and I think it always will be as long as this is well-run as it is now. All right, I think Netflix, people, deserves the benefit of your doubt. That's why I'm sticking with the bullish side of the trade. By the way, I'm doing that with Disney, too, as you heard from the questioner. I don't like to deal in pure hypotheticals. Much more Mad Money, including my sweep with paychecks after last Wednesday's 52-week high. Then don't miss my breakdown of the state of specs in this tape. I'm looking closer at the tricky timing and giving you some stocks to add to your watch list. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.